Hello everyone, welcome to Experian's BI Forum. Today, Koketso and I are going to be talking to you about commercial credit score insights and that aid faster and smarter decisions. First off, let's look at the benefits of using a statistical scorecard model. The first benefit is quick decisioning. This allows you to get a better customer experience. It's much more efficient than manually assessing applications and is suited for digital imperative and growth. Statistical models are also very accurate. They're based on statistical methods. They can be measured and monitored over time to ensure that they are performing as intended. And there's different scenarios that you can test what is possible in terms of bad rates and acceptance rates. Statistical models are also extremely consistent. They remove the inconsistencies of manual underwriting and human error. They're very much up to date and can be refreshed regularly, and trends can be identified in terms of scores that you can use in strategy. And lastly, we're looking at ranking. A score provides you a risk ranking, and it can be used to create risk-based pricing and facility allocation and deciding on limits of credit. I'm going to specifically be talking about Experian's Sigma commercial score today. And let's look at some background of that score. There's some reasons for Experian redeveloping our commercial score and coming up with our Sigma commercial score. First off, the score was developed using a new target definition compared to the previous commercial scores that Experian has. The Sigma commercial score uses a propensity to pay as the target definition, whereas our prior versions of our scores use the target definition of the probability of business failure. Next, during the development of, we gave special attention to ensuring that the clumping of the score was avoided and that too much weight is placed on variables that are not available for all entities. We ensure that we create buckets across the different variables that'll give you a nice granular score. Then the principal behavior we captured better with our Sigma commercial score by using our Sigma principal variables. These are variables that did not exist when the previous commercial score was built, and they really help to identify risk of principals and to describe the principal risk. And our Sigma commercial score was built on more recent data, and as the results captures current market risks and trends. More recent data will always mean more accurate predictions. So once again, we'll look at the differences between the Sigma commercial score and our previous commercial scores. The main difference is the different bad definition of the score. We look at a propensity to pay. So this looks at, and it's a 12-month outcome window. So we look at instances where entities go overdue. Their overdues are larger than their outstanding credit commitments, and that will be flagged as a bad in this model build. The Sigma commercial score is also only available on the new BIQ platform. The score is much more granular. We're ensuring that smaller groups are assigned points and we have more granular points distributions. And we also give the raw score and not just a risk bucket. What this means is if you have a raw score, you can create much more granular cutoff strategies that is tailored to your own business. Now let's look at some of the more finer details of the score. In terms of the Sigma commercial model development, we predicted the propensity to pay, and this is based on ledger data of business entities. The development period for this score was January 2018 to April of 2019, and we tested and validated the score on the out of time in a recent period between 2019 and 2021. And like I mentioned before, the bad status for the score is we look at entities where more than 100% overdues on outstanding balances in the 12-month outcome period, and the overdues also based on the terms that are supplied by the credit providers. The Sigma Commercial Score is split up into 3 different segments. Our first segment that we're looking at are non-SMEs, so large companies. The definition for that would be greater than or equal to 8 million rands in turnover, or greater than 500 employees, or it's a PTY limited business. The next segment is our SME segment, or the small segment. These are entities that have less than 8 million rand in turnover a year and have less than or equal to 500 employees. And the last segment is our non-research segment. These are entities where we do not have the information around turnover or the employee number of employees. Looking at the data that we used in order to create this score, first off, we're looking at the CIPC data. So this is the company's Intellectual Property Commission registration details. And we look at it for all of these commercial entities that are registered with CIPC. We look at our research data. Now, this is data that Experian collects on commercial entities when commercial research reports are done. We look at judgments data. This comes from the commercial judgments public domain. We look at our trade line data. This is monthly ledger data that is supplied to Experian, and it's essentially payment performance. And lastly, we look at our Sigma data, and this is aggregated consumer risk data that is linked to the principles. We build different types of variables for the principles that we roll up into one value that helps to describe the risk of an entity. This is especially useful on the SME side or sole proprietors. Now, as we all know, the proof is in the pudding. So let's look at some results of the Sigma Commercial Score. Our non-SME segment, which is the large segment, you got a very good development Gini of 43.1. As you can see, it's a nice rounded curve, and the out of time and the development samples are very close to each other. The next segment we're looking at is the SME segment, the small entities. There we got a development Gini of 40.1. And again, it's a nice rounded Gini graph. And lastly, our non-research segment, we got a development Gini of 41.3, which is also very, very strong. Next, we want to look at the bad rate graphs of all of the different segments and if the bad rates rank according to the scores. When you're looking at these graphs, it's split up into 10 deciles. So it's 10% bands of all of the scores. And on each of the bars, you'll see the bad rate for both the development as well as the out-of-time sample. And you can clearly see on all of these segments that there's a very, very good ranking between the different score bands. With, for the non-SME segment as an example, you've got your development bad rate at 50% for the 10% of the worst scoring population, and it's sitting at like 2% for the lowest 10% or the highest 10% of the scoring population. You can see the same trend on the SME side, very good ranking for this model, and the same on the non-research side. And the next slides will show the different buckets itself, but you can also see that there's a bit more bad rates on the SME and on the non-research side than there is on the non-SME side. Now we'll look at the risk bands of the score. We split these up into a little bit smaller buckets. So we've got a 5% bucket at the top and at the bottom. And then we've got a 10% bucket just outside of it. And then a 20% buckets either side and a 30% bucket. And the score differentiates really well between the different bad rates or the different buckets. We've got the SME segment sitting at 56% for the highest risk 5% population, with the overall bad rate of the portfolio sitting at 24%, which is right here in the middle. And you can see there's really, really good differentiation between the lowest risk and the highest risk. You can see the same happening, even a larger disparity between the average and the highest risk population. So this SME segment is especially good at identifying the really high risk entities. The average risk of this portfolio was 32%. And on the non-research side, there's even better differentiation. Our average risk of this portfolio is sitting at 37%, and 81% bad rate sits in the lowest scoring 5% of this segment, which is really, really good differentiation. And we're able to identify the clearly high risk entities very, very well. That's all from me.
Thanks, Chris. And hi, everyone. My name is Gogejo, and I will be taking you over the IFRS 9 impairment model and how you can use the commercial score to enhance your impairment modeling. So for those that are not familiar with the standard, IFRS 9 was implemented in 2018, but it was actually introduced to mitigate some of the instances that came out of the 2008 financial crisis. So the standard focuses on three parts. One, how to classify and measure financial assets. Two, the impairment of those assets or some of those assets. And three, to do hedge accounting. For most of today, we'll be looking at impairing financial assets. And this is because we're going to be looking at how we can use the commercial score to project the cash flows on a portfolio. So the main idea behind IFRS 9 is that you recognize an expected credit loss on your portfolio or on your loans portfolio. Now, the calculation here goes where you take your outstanding balance or the present value of your contractual cash flows, and you subtract what you expect to lose from. You expect you minus or you subtract what you expect to get from this portfolio, and the difference, of course, will be your impairment, your ECL. Other people call it the cash shortfall. So again, the commercial score can come in very handy in terms of doing this modeling work. But besides IFRS 9, this exercise can be performed to have a look at the cash flows that are going to come from your portfolio. You're not necessarily restricted to the approach here on impairment modeling. You could use it for cash flow modeling. So maybe just to go over the process start to end, Chris has already shared the different bandings that we can use from the commercial score. So this allows you to split your portfolio into different risk bands, right, that show different performance behaviors. And when you look at the segmentation here, you could possibly enhance it, and we'll touch on that in the next slide. And once you have segmented your portfolio, you can then look at, okay, these different pockets of my portfolio, how do they perform in terms of previous cash flows? And once you bring that in, you have, in a sense, a projection of how your portfolio is going to perform in terms of cash flows. You can then use those cash flows that you've projected and take the difference, right? So you look at the balance on your portfolio and how much you expect to receive from your clients, and you take that difference and you compute your IFRS 9 impairments. Of course, there are other requirements that you have to account for in terms of computing IFRS 9 impairments, such as are you using the correct effective interest rate? Have you accounted for staging if you're going to take that approach? Generally, in this world, it's advisable to take the simplified approach, because then you don't have to worry about staging. I'm going into the details of IFRS 9 here, but if you're not concerned with the IFRS 9 impairment modeling, then you don't necessarily have to focus on this third part, but it is something that you can take, given that you've projected your cash flows in the previous exercise or in the previous step. And then once you have your IFRS 9 impairments, the positive with using the commercial score is that if you had used the commercial score in your acquisition strategy, you now have a framework where you can now model your impairments using the same score that you use for acquisition in your impairment reporting. So you sort of have a consistent risk reporting driven by the commercial score. All right, so those are the different parts that you can take with this score in terms of this use case. Of course, you can extend it to other areas, but for now, we'll be looking at how you can, follow this train of thought. So just to do a recap, this is some of the results from Chris. And the main takeaway here is that, you can take your portfolio, if you have some non-SME companies on your portfolio, or some SMEs and other companies that are not necessarily researched, there is some separation in terms of that segmentation. So SME versus non-SME. But there's also, within SME and non-SME, there is separation between the different risk levels in your portfolio, where if we look at the non-SME table, the highest risks show a bad rate of around 56%, whereas, your lowest risk shows a bad rate of 2%. So you can see that, there is separation in terms of risk from your book, and that needs to be accounted for when you project your cash flows or when you model these expected cash flows. And, just to add on that, in terms of IFRS 9 impairment or even for cash flow modeling purposes, you don't have to necessarily stick to this level of segmentation. So if there's some segmentation that you already know in your portfolio that show separation in terms of performance, it may be, companies that were, brought onto your book post-COVID versus the ones that were there pre-COVID. Again, this is just an arbitrary segmentation that I'm giving up here. You can come up with other segmentations that you're already comfortable on your portfolio and use that to segment your portfolio. But the main idea here is that we want to extract different pockets of your business that we know perform differently based off of cash flows. Because when we are going to project our cash flows, it will be very handy if there's very, distinct separation in terms of performance from these portfolios. Again, another band that you could add to this is a default band. So if there's guys that have shown that, they have defaulted and they've missed a couple of payments in IFRS 9 terms, that's usually 90 days plus, depending on how you define default on your portfolio, you could add that as a band. And then that, when you're modeling your cash flows, that defaulted guys are modeled for separately. All right. So once we are done with segmenting our portfolio, we'll then look at how do we model, accounts moving between these different states, right? So the main idea behind IFRS 9 or cash flow modeling in general is that you are trying to compute some form of expectation. Now, generally, this expectation is based off of the history of your portfolio. So what we have here, maybe we can start with the table on the left. So the table on the left shows on the rows, we have the current risk banding or segmentation, assuming that you've possibly enhanced your segment, how they look a month later, or quarter later, depending on how you report your results. And we can look at the table. The first cell there would say, 33,000 of the accounts that are currently in the lowest risk segmentation or the lowest risk band, 3,000 stay in the lowest risk band, and 195 move into the below average risk. So it sort of gives you an idea of the behavior of your portfolio. Equally, we can look at the guys that are currently in or they're rated as average risk. How do they look a month later? And that is the fourth row on the slide or on the table, and looks at 16,000 stay in average risk, whereas 234 move and actually improve into below average risk. So it gives you an idea of how your portfolio behaves on average. This can be taken over a year, 2 years, depending on how long you want to account for the different movements. And it also depends on data availability. So you find that, over a year, the transitions or the movements between the different bandings is not that significant. You don't have enough volumes to bring stability into this matrix. We will then extend that window and potentially cover 2 years where we get a bit more volume. Again, it differs from one business to the next. Another idea that I already mentioned from the previous slide was that you can enhance the segmentation, right? So this matrix could be made, if this is a 4x4, you can make it a 6x6, where you perhaps include, something like account closures, right? So of course, your customers, as much as they have different risk bandings, some of them do pay you off and, they go into a settlement state. So that's something that you could bring also so that we can monitor it. And we know, for example, the guys that are in lowest risk, how often do they actually settle? And equally so, the guys that are in high risk, how often do they, settle? And of course, it will give you a sense check because you generally expect the lower risk guys to be settling more than, your high risk guys. Again, so that's just to cover that point again, that we can, include other states. Doesn't have to be limited to this. Could be account closures, or possibly if you have, accounts that you put in probation where we're not collecting any cash flows, we can introduce that state as well, and we account for it in our modeling. And the main idea here is that this transition matrix, or the movements of accounts between your risk segmentation, should follow closely to what you actually see on the ground, because then that will give us a very good base and give us results that are fairly close to what you see on your portfolio. So now that we've counted, the different movements each account makes, we can then calculate the transition matrix. So transition matrix really just takes the volumes and takes if we look at maybe possibly as an example, the first row, 97% would be saying, that the probability of staying in low risk, given that you start in low risk today, is 97.5%. And the probability that you move from a low risk customer to a low risk customer is 1.9%. Of course, these volumes are done for demo purposes. Given your portfolio, we can construct these matrices and see the behaviors of your portfolio. Another example would be, still on the right table, the probability that an average risk client stays an average risk is 96.4%, whereas the probability that they improve is 1.4, but the probability that they do deteriorate by one risk banding is 2%. So this gives us a very good idea of, how your portfolio moves between the different risk bands. Now, remember, we're not just projecting cash flows over just 1 month, right? We want to, IFRS 9 speaks about this idea of a lifetime of a loan. So if you're giving out loans that go for over 36 months, you potentially need to project cash flows for that period. And if the accounts are worth 12 months, you need to project for the next 12 months as well. So on this slide here, we talk about how do we get from that one matrix that we've computed to the lifetime view, or to more months than just the 1 month that we've computed. And again, this is assuming that, we have limited data. If we have a lot of data, that matrix that we computed previously could be computed for the different ages. So as an example, the probability of moving from lowest risk to low risk when an account is just, invoiced, or it was just brought onto book, may be different to the probability that an account can go from low risk to medium risk if they are at age 12, right? So there's generally a separation between the different risks based on how old the account is. Now, in the absence of enough data, we compute one matrix and we use that matrix to go into the future just for stability purposes. So in this case, then, if we look at the very first matrix, that will be that matrix that we calculated initially for all the data. And to get a view of how those probabilities change for 2 months later, we take that matrix and we multiply it by itself, assuming we are using one matrix. If we're using two matrices, we'd look at the matrix from 0 to 1 and look at the matrix from 1 to 2, and we multiply them together. Again, these are considerations that we'll take into account depending on your portfolio. But for simplicity purposes for today, let's just focus in the case where we have one matrix. So to get from 0 to 2 months later, how the portfolio looks after 2 months, we're going to take that matrix and multiply it by itself. That will be the second matrix on this picture. And what that says is, on the original matrix, so the one to the far left, the probability that an account starts in lowest risk and stays in lowest risk is 97.5%. Now, 2 months later, the probability that an account today is lowest risk and 2 months later it's still in lowest risk is 95.3%, which makes sense, right? You have 2 months to default or 2 months to move away from the lowest risk stage. So we expect that number to generally decrease. Now, by multiplying the two matrices together, you're not just accounting for the guys that have started in lowest risk. You're accounting for the guys that have potentially moved back into low risk or moved out of low risk and back into that stage. So, you account for accounts that maybe today they're lowest risk, next month they are in medium risk, and for some reason they improve their cash flows and they're going back to lowest risk. So all those, permutations and combinations of how your portfolio can move are accounted for by multiplying the two matrices together. Now, generally in IFRS 9, we talk about the 12-month, ECL. So we need to then multiply this matrix by itself 12 times. And that's the third matrix that you get there, where now that first row says, the probability that an account today is lowest risk, and it's all still lowest risk 12 months later, is 80.4%. So it gives you a fair idea of how your portfolio will perform over time, right? And there is ways that you could calibrate this to make sure that it follows, other reporting metrics that you do in your portfolio. We're not going to focus on that today, but there are ways. If you maybe look at this and you say, this is not how my portfolio behaves. One, it may be that we need to revise the segmentation, or two, we could find a way to calibrate this matrix such that it represents what you see on the ground. Again, given that you've multiplied this to 12 months, you can extend this, until 60 months or however long that you need to go. But around 60 months, that's where things start to stabilize and you don't really get much value in terms of going beyond that point. But you can do that exercise. So up to this point, we have an idea of how the accounts move in between the different stages. So it gives us an expectation of, okay, if I have an account today that is average risk, I have an idea roughly of how it's going to move in between the different risk bands over time in terms of probabilities, right? So now we can add another layer onto that by considering, for each band, how much money do we generally get? And this would be the focus for the next slide. So in this slide, I have two tables. One, the one on the left is for an account that started in low risk today, how the transition probabilities look for that account. And then I have on the right an account that started today as an average risk account. How does the transition probabilities look for that? So if we look at the table on the right, it says, for an account that is at average risk today, the probability that it's still in average risk 12 months later is 69.48. And the probability that, it has improved into lowest risk 12 months later as 1.94. Whereas on the left-hand side, we're saying an account that started as low risk today, it has a probability of staying in low risk at 80.43 and the percent, and probability that it moves into average risk is 1.67, and the probability that it moves to the highest risk is actually quite low at 0.03%. Now, given that we've segmented our portfolio, we can then compute collection rates for each segment. So, if you have SME guys that are low risk, generally, what's the payment that you get from the clients divided by, what was due for that month. So these are monthly collection rates. So you take your collection rates monthly and you take the 12-month average just so that you don't have a lot of noise in your collection rates. And so the table on the left would then say, the guys that are currently, low risk, we generally get, as a portfolio, as the pocket of that portfolio, we generally get 90% of the installment that is due, month on month, right? So for every month, when we expect $1,000 from the guys that are at low risk, we normally get 800. We normally get 900, and you can sort of model those collection rates for each pocket of your portfolio, from the lowest risk all the way to high risk. Now you'll see that for lowest risk, we have a collection rate of 108%. And that's generally because the good guys will normally overpay, right? So if that's the experience on your portfolio, that the guys that are very low risk normally overpay, maybe to try and settle their accounts early, or whatever the case may be, that collection rate would capture that behavior. So now, we have a sense of how much we get from a client, and we also have a sense of where, in terms of the risk banding, this client will end up 12 months later. We then take a product of the two. So we take a product of the probability and the product and the collection rate, and we get some form of expected collection rate for each client. So for the table on the left, when you look at the blue there at the bottom, we're saying for accounts that are currently low risk, we expect at 12 months to get the full installment plus something more. Again, this is for the portfolio, for the for the portfolio, right? So some guys will pay the installment as is. Some guys may actually not even pay, but you have guys that overpay as well. So as a portfolio, we expect on average that that pocket of your book will overpay by roughly 1.8% or 1.9%. Equally so for the table on the right, the guys that start at averages today, after 12 months, we expect to get on average 52.96% of the cash flows that we expect. Again, some of these guys would have defaulted potentially, and some of them may have improved and moved out of the average risk. But on average, for this average risk portfolio, we expect that we're going to get 52.96% of the installments that we expect. And now, given that we now have some form of expected cash flow, right? So if you do this every month for all the different segments, for each pocket of your portfolio, you have a sense of how much you expect to receive today, a month later, 2 months later, 3 months later, up to 6 months, 60 months, depending on how far you want to go. Right? So for someone, the exercise may end here, where we have a sense of what our expected cash flows are going to be going into the future. So the table there at the bottom just brings it all together at home where, if we have if we have a portfolio where 320,000 is the installment due on the lowest risk segment of our portfolio, we expect that in 12 months, these guys are going to pay us, 326,000. Of course, if you have captured, your settlement stage as well, maybe that would have brought down where some of the money went into the settlement stage where they were paying off their accounts. But for now, in this simplified world, that would be the expectation. But again, we'll calibrate this so that it fits or it mimics your portfolio. And then as an example as well, for the average risk guys, if we have an installment due of 420,000, so that whole portfolio month on month owes you for 420,000, we're saying at 12 months or 12 months from today, we expect that pocket of your portfolio to on average have paid you around 222,000. So this gives us a sense of the cash flows. Now, for IFRS 9 purposes, we're very close into getting the computation. But if all you're interested in is modeling your cash flows, you can do this exercise where, for finance, it may help with budgeting purposes or whatever the case may be. All right. Now, bringing it back home to impairments or IFRS 9 impairment modeling, the ECL can be thought of as, and there's the formula at the top right. So it will be your loan balance, or you can think of this as your present value of your, contractual cash flows, minus, those projected installments discounted by the effective interest rate. And that difference would give us the expected credit loss. Now, for each installment, for each segment of your book, because now you'll be looking at a pocket of your portfolio, you may compute, the average effective interest rate in that pocket, and that's the effective interest rate that you would use to discount the cash flows for, say the lowest risk guys. Now, in terms of, modeling your portfolio, you can compute the cash flows for each account potentially, and, you treat the guys that are in the same band together. Or alternatively, what you can do is compute the coverage ratios. So the coverage ratio is the expected credit loss divided by the outstanding amount. So you could compute a coverage ratio for a unit of exposure or for a unit amount of outstanding amount, and then you use those coverage ratios to multiply to your balances for each account to get your ECL. So, following the numbers that I've shown you in this presentation, we've computed the coverage ratios using a unit of exposure or unit of outstanding balance. And the results we got, using these fictitious numbers is that, your lowest risk guys have a coverage ratio of 6.76%. And what that means is, given you have an outstanding amount of 1,000, you expect to hold 67 rand 6 cents for those people as an expected credit loss. And equally, for guys currently in your portfolio that are at low risk, you expect to hold roughly 19.75% as an expected credit loss. You can see, given those transition rates, that your coverage ratios follow in line with what you expect, right? You would expect to hold a bit more in provisions for your highest risk guys compared to your lowest risk guys. So this gives us a framework of how we can model ECL on our portfolio given the projected cash flows. We can use the actual cash flows that we project for each account, or we can compute the coverage ratios for each pocket of the portfolio and use those to multiply by the amount or exposure that is in that pocket of your business to compute your ECL. Again, in terms of IFRS 9, requirements, there's a lot that is left out here in terms of, accounting for collateral, possibly, there's multiple components in terms of IFRS 9 that need to be accounted for, but the overall idea still stays around, right? Where, overarching, you're going to do these coverage ratios, but then you can account for the small things or the other considerations in terms of your collateral, effective interest rate that you use, what do you consider your lifetime if you possibly have revolving credit, right? So all those things may need to be accounted for to make sure that your model is, if it's not compliant, but the idea, still holds. And, from this point of view, you have essentially then taken the score that you've used in your commercial acquisition strategy to sort of follow suit into your ECL computation. And this is something that is encouraged by the IFRS 9 standard. And I will end my presentation there for today.
Good day, everyone. I am Chad Johnson, a research team lead within the BI Research and Reporting Department. And today I'm excited to take you through our commercial fraud process, recently introduced within the BI space, and the value to add to our clients. Our agenda for today, I'll be taking you through the fraud background, the fraud checklist, the fraud process, our fraud database, providing you with a stats update and learnings and continuous improvement, and lastly, our client first approach, which forms the basis and the value of our process. As I mentioned, we'll start off with the fraud background. The fraud background consists of early signs, feedback from clients, working together with external stakeholders, changing our approach, and implementing a process. The journey and the process started with reflection and intervention, going back a few years to early signs and findings on the commercial fraud and how it was initially discovered. Our clients were key in the process as they gave us the initial indication, feedback, and information, which allowed us to dive deeper and brainstorm on these malicious incidents and negative financial impact it had on their businesses, which turned out to be fraud. We had several external stakeholders, partners who provided us with great insight and assistance in the beginning, especially on the fraud cases that we initially identified in certain companies that were red flagged across the certain industries at the time. As you would expect, we needed to relook at our current process from start to finish, and it was important for us to change our approach when looking at fraud and what factors and measures need to be in place to combat fraud and ultimately ensure our clients are not negatively impacted by fraudulent activity, which led us to develop and create a process. On the next slide, it shows it is the fraud checklist process. The fraud checklist process is a 40-point check that is conducted on every report. The report journey starts when a report is created and requested to when it is completed and delivered to our client, and all the in between. Okay. So within our fraud checklist, as you can see, it starts off with research team, and research team has three functions, which is pre-call checks, interview, confirmation, and verification. It then moves over to our assessment team, who's responsible for the financial data verification, and then moves over to the last step, which is quality control, who does the final quality check and validation. We're starting off with the research team. So the research team is responsible for conducting interviews, sourcing the information, and does the research and reports investigation. This is a critical part of the process as it is the first point of contact between the BI team and the data subject. This step is about obtaining as much information and conducting all verifications of information we either have on hand or has been provided to us. So this process, when we say pre-call checks, which is the first part of the research check, is about reading and understanding the special instructions given to us by our clients, looking at the inquiry amount, because the inquiry amount tells us if we are allowed to ask for financials or if financials is needed or not. Check for previous inquiries on the subject on our database. Look out for unexplained gaps in the company's history. Dormant periods should be a concern. And then lastly, check if we have a significant increase in requests to research a specific subject across alternate subscribers. So this initial step of pre-call checks is being able to understand the business at a glance before making the initial phone call to the data subject, and further understanding the importance of what questions to ask. Double check and importantly, find answers to any gaps identified initially. We then move over from the pre-call checks to the interview. So the interview is the interaction with the data subject, the first call made to the data subject. So for us, it's pay attention to your interaction with the data subject. We have to recognize tone. Is the relevant person over friendly or too keen or too willing to provide information, and that the speaker is not given information from the third party while on the phone. So we had instances where we'd be speaking to the relevant person, but we can hear in the background while we're confirming company information, there's someone is providing it in the background. So it's key for us to pay attention to that. So we use this small indications for us to check and use as a guideline when conducting an interview. And then the third step for the research team is confirmation and verifications, which make a large part of the fraud checklist because it's confirming and verifying majority of the business activities, information that's related to the director or the business itself. So it starts off with business information. So to check CIPC to confirm business information, name changes, registered name. Then we move over to registration details. Check registration date compared to the start date of the business. Check VAT number, tax number. Then we have principal data. Check CIPC to confirm if the director's information versus the report request information, ID numbers, everything makes sense. So whatever we have on file versus what they've provided us of what we managed to accumulate, does it all make sense? Does it all add up? Address and registered address, check and verify the business directors and accountants and auditors' physical address. We'll check on Google Maps, Street View websites. Are they based in the same province? Check if the director residential address is in the commercial area and is the same as a company physical address. So that's industry specific. We also check premises type in relation to the operations. We had cases where the data subject is involved in distribution or warehousing, but when we found that the residential address or the company address is in a office park, which doesn't make sense. So are the subject and subscriber in the same industry? We also take note of bankers. Take note if the bank account has only been recently opened. We take note of staff. Does the staff count match the type of business? We look at fleet. Does the fleet size match the type of business? We look at the operations. Is the subject's operations in line with that of the subscriber whom they are approaching a credit facility from? And then also a big part of it is trade references, supplier information. Does the products or services provided by the supplier match with the nature of the subject's business? Are there uncommon references? Example, trade reference, line of business in a distribution of hardware, while the subject is in wholesale of groceries and non-alcoholic beverages. So also confirm trade ref numbers. So cell numbers are usually red flags. Landline numbers as well. We usually find there is a common numbers, maybe the last four digits are similar in 4 or 5 different numbers. We know that they're all linked. All the suppliers are maybe linked and working together. We can see, and are the companies reputable? Do they have company websites? And we have to check if it's not on our current fraud list or current fraud database. And we check if there are prior requests from our clients on the subject, contact them for a trade reference. So at times we would contact some of our clients to ask about certain data subjects because it's part of our fraud check. And then we move on to financial information. Are there any red flags identified when viewing financials? So yeah, last part was the ledger information. Check database for ledger information. Are they trading elsewhere? Are all part of the fraud checklist and needs to be answered as clear when completing the above questions. If not clear, it will be highlighted as a risk. The report process or the report then moves over to the next phase, which is the assessment, which is the assessment team. So assessment is our internal credit assessors who provide the report recommendation and insight into the financial position of the business, looking at several indicators when providing a recommendation. The crucial part for the assessment team when identifying fraud is having a view of the financial statements. Viewing of financial statements allows us to deep dive and identify the following, right? If you look at the AFS checks, the first one is other financials within the assessment period, not older than 18 months. Is there an accountant or auditor letterhead, practice number, membership number, and physical address? Number 3, check the above on Psyker, Cyber, or Urba, or Cyber just to confirm the accountant or the auditor. Then we need to distinguish between compiled, reviewed, and audited financials. We move over to the financial analysis part of it is, are there significant increases in revenue? Does the purchases reconcile with the credit limit apply for? Solvency and equity-based standing. Looking at net working capital, check if the fixed assets, motor vehicles correspond to the fleet size, fixed properties to confirm if premises owned, and we check cash flow review, check salary paid and staff if they correspond. Does trade references correspond with the trade and other payables? Check if the revenue earned speaks to the operation. So yeah. Then we go look at balance sheet versus average monthly purchase analysis, compare accounts payable to trade references data, average purchases. And if some of the information provided or on the financial statements don't make sense, we'll call to confirm with the accountant or auditor if we're alerted by anything. Similar with the research checklist, questions need to be cleared while completing the financial analysis of the AFS. If not clear, it will be highlighted as a risk. And then the report moves over to the final phase, which is quality control. So the quality control is the last line of defense. They receive the report which has been submitted and captured by both research and assessment teams respectively, and then make sure the story adds up. Everything collates and the report makes sense. So that's the fraud checklist part of it. We then move on to the process, the fraud process, and what we look for, right? So the fraud process and what we look for is a step. This step is how we arrive at a decision or a recommendation that is eventually communicated with our client. So step 1 is all research reports undergo a fraud check process. Our 40-point check process helps us identify and classify an entity as either fraudulent or suspected fraudulent. Step 2, all individuals working on the report come together to discuss their findings. After reviewing and analyzing the data collected from the researcher and assessor, a decision and outcome are reached. Step 3, our findings are then shared with the key internal stakeholders within the sales team. Proceeding a decision about whether the subject is fraudulent or suspected fraudulent, an internal process is followed to assign triggers to the entity. A fraudulent entity score will be assigned a maximum risk grade score of 1. And then step 5 is the collaboratively with the accounts manager, we share our findings with our client. We provide feedback on our recommendation and further emphasize the importance of conducting due diligence, KYC, and site visits to mitigate risk and identify fraud before transacting with any new customer. This process now takes on a more collaborative effort based on the findings in the previous step. We need to gather all information, risk, red flags, alerts, gaps, or any discrepancies found in the company. Amongst all internal stakeholders, we arrive at a decision and on whether we find the company fraudulent or not. Okay, this team process or the fraud process is a continuation of the fraud checklist. And then we'll move over to the next slide, which is the fraud database. The fraud database consists of confirmed and suspected fraud cases, consists of an averted or cost calculation, and any additional information that's related to our confirmed and suspected fraud cases. So the first tab or the first topic in our fraud database is confirmed fraud. So several alerts or red flags are identified in the fraud check process when compiling a research report for a subject. Evidence found and adverse information provided together with information on hand indicates the company is at high risk for our clients to enter into any transactional agreement. Suspected fraud, this is where alerts or red flags are identified on an entity through our investigative process when compiling a research report. In this case, there is not enough evidence to suggest it is confirmed fraud, but several warnings identified are enough for us and our clients to be cautious of the data subject in question. In the case of suspected fraud, the business risk grade score will not be decreased to 1, but a fraud trigger will be inserted on the company profile, and our alerts will be made aware, and our clients will be made aware of our findings. And then the next is our cost calculation. So it's a record of the cases we've identified thus far and the risk we've managed to mitigate in credit lending and bad debt for our clients. So our confirmed fraud value amounts to 75,563,500 Rand, and our suspected fraud value amounts to 26,565,000 Rand. The next tab is additional information related to confirmed and suspected fraud cases. So it contains a database of adverse information we've identified in our process on confirmed and suspected fraud cases. This provides insight into trends within specific industries or similarities within the data subject we've identified. So at times we'd identified similar trade references, supplier information. We'd maybe identified a similar director being involved on multiple companies that are linked to fraud. Bankers, we often see maybe the same bank linked to multiple of our fraud cases. Auditors, we see the same auditors involved, and a physical address that we've seen. So that's our fraud database and what it consists of. We'll move over to the next sheets, which will be the stats updates. So it will be 3 sheets with stats updates that are taken from our fraud database. The first one is the number of identified confirmed and suspected fraud cases, 57 confirmed fraud cases, and 26 suspected fraud cases. The numbers don't shout out problem or major issue, but if you look at the costs associated with the numbers and to each individual report, the number then becomes quite a bit more significant, as you will see in the next slide. So personally, we would not like the number to increase, but if it were to increase because of desperation in the market and the economy, we would then prefer to have the number saved on our stats or database, as it would be a number or case where we fortunately were able to identify and avoid any risk associated with the fraudulent entity. So it will be one of the cases where we found fraud and we've been able to alert our client before any risk has come to our client. So yeah. And then the next slide shows the cost value linked to those cases. So for confirmed fraud cases, you're sitting at 75,563,500 Rand, and suspected fraud cases, you're sitting at 26,565,000 Rand. So this is the financial loss prevented through the fraud process. So as I mentioned earlier, in the number 57 and 26 previously mentioned in terms of cases, it doesn't look a lot, but if you look at the cost or the value of it, it indicates a significant impact it has on our clients and the business in general, which is what we're driving to avoid and work with you to mitigate any future loss. It has a severe impact on the bottom line and what could be lost in terms of goods and services. We deal with small to large companies, and some of our smaller companies can't risk losing this amount of cost, as a business might not be able to recover from it. For medium to large will survive, but repeated instances could be detrimental to the business. And the last slide when it comes to our stats is our industry specific. So from our data, we're able to review all fraud cases on file and identify the most targeted industries and where fraud is most prominent. As you can see, it's a 80 to 20% split. 80% of or majority of the cases stem from industries such as retail, wholesale, and manufacturing, and the 20% is other. So at the moment, you're seeing a large volume of our cases in the space of retail, wholesale, and manufacturing. And it could be manufacturing, of course, it could be retail of so related to construction, wholesale of groceries and good hardware. We're seeing a large number in that space. And then moving over to the next slide is our learnings and continuous improvement, our commitment to continuously improve, learn, and grow as a department. Our knowledge and experience has improved significantly over the last few years. Continuous improvement along with client engagement and collaboration is key to prevent and identify fraudulent activity in the commercial space. So our current process and ongoing learnings will place us in a position to alert our clients and mitigate any future risk. Mitigating risk will require collaborative effort between you and Experian. We are unable to identify a potential risk. Due diligence, KYC would need to form part of your onboarding or review process. The goal will always be fraud prevention and being a support mechanism for our clients. Moving over to the last slide, which is the client first approach. So we strive to put our clients first, but that means adding value and providing legendary service. This goes not only for the fraud aspect of our product offering on all our reports, but for the entire report. So client first approach is due to the increased fraudulent activity, it is imperative that you work together to mitigate risk and potential loss. Our goal is to provide our clients with a comprehensive, timely, accurate, reliable report, which adds value to your businesses. And a quote that we love by is that the goal as a company is to have customer service that is not just the best, but legendary. And that brings me to the end of my presentation. Just like to say thank you to everyone for joining the forum. I hope you guys enjoyed it, and I hope you found value in what we're able to provide. And thanks so much. Have a good day further.